a hotel that helped build modern Las Vegas, is now showing signs of structural decline. Not collapse, not yet, but something underneath is no longer holding. Why is this happening? What is being hidden behind steady occupancy numbers? And who is really benefiting from a property that continues to generate revenue while the guest experience deteriorates? Because this is not just about outdated rooms or rising fees. It points to a deeper imbalance. A system still extracting value, but no longer reinvesting at the same pace. And if that pattern continues, the issue is no longer the hotel, it becomes the model itself. Subscribe, follow, and turn on notifications as we break down what is really happening inside Las Vegas. The Flamingo Las Vegas opened on December 26, 1946. At the time, it was one of the most ambitious resort developments in the United States. Built with an estimated cost of around $6 million, it introduced a new model to Las Vegas. Not just gambling, but a complete destination. Hospitality, entertainment, and gaming integrated into a single property. It quickly became a defining symbol of what the Strip would eventually become. For decades, the Flamingo held a clear position in the market. Central location, high visibility, accessible pricing. It was not the most luxurious resort, but it was never meant to be. It operated as a volume-driven asset in a growing market where demand was expanding and expectations were lower. But Las Vegas did not stay the same. Over the past 20 years, the Strip shifted toward large-scale, capital-intensive resorts. Properties like Bellagio and newer developments redefined what a modern Vegas experience should feel like. Higher standards, higher spending, higher expectations. And this is where the contrast becomes unavoidable. The Flamingo still sits in the center of the Strip. The location has not changed, but everything around it has. What was once competitive is now outdated. What once defined the market is now struggling to keep up with it. And that gap between past identity and present reality is where the current pressure begins. Today, the Flamingo Las Vegas operates within a structure that is very different from its original model. The property is operated by Caesars Entertainment, one of the largest gaming operators in the United States. But like many assets on the Strip, the underlying real estate is no longer simply held in a traditional ownership model. Over the past decade, Caesars restructured a large portion of its portfolio following its 2015 bankruptcy and its 2020 merger with Eldorado Resorts. This included monetizing real estate through sale-leaseback transactions. In these structures, the land and physical property are sold to a real estate investment entity, while Caesars continues to operate the casino and hotel under a long-term lease. These leases are typically structured as triple net leases. That means Caesars is responsible not only for rent, but also for taxes, insurance, and maintenance. Fixed obligations increase, flexibility decreases. And critically, these leases often include escalators. Rent increases are built into the contract over time. So regardless of short-term performance, the cost base rises. At the same time, Caesars carries significant corporate-level debt, much of it tied to prior restructuring and expansion. Debt servicing obligations do not adjust based on individual property performance, which creates a layered pressure. The Flamingo must generate consistent cash flow, not just to operate, but to support a broader financial structure. And this is where the mechanism becomes clear. Even if the asset is aging, even if reinvestment is limited, the system still requires output. That is the constraint shaping everything else. By 2025, Caesars Entertainment reported that its Las Vegas segment generated approximately $4.3 billion in annual revenue, but declined nearly 10% year over year. That contraction is significant for a core market that traditionally drives stable cash flow. Adjusted EBITDA for the Las Vegas segment also showed pressure, declining as margins tightened under rising operating costs and softer demand. While exact property-level data for the Flamingo is not disclosed, its performance is embedded within this broader segment trend. Visitor data reinforces the shift. According to the Las Vegas Convention and Visitors Authority, total visitor volume showed periods of stagnation, with some months underperforming prior year levels. At the same time, spending per visitor became more uneven. This creates a split dynamic. Occupancy across the Strip, including properties like the Flamingo, has remained relatively stable. Rooms are still being filled. Foot traffic remains high due to location advantages. But revenue quality is changing. Higher reliance on fees, increased pricing pressure, greater sensitivity from guests on total trip cost. Segment-wise, high-end resorts continue capturing premium spend, while lower-tier properties compete aggressively on price. The Flamingo sits between these segments, without clear pricing power or cost advantage. And that is where performance becomes more fragile. Because stability in volume is no longer translating into stability in margin. The pressure is not coming from a single source. It is layered. Start with fixed obligations. Under a triple net lease structure, operators like Caesars Entertainment are responsible for rent, property taxes, insurance, and maintenance. These are not variable costs. They do not decrease when demand softens. And with built-in escalators, rent increases over time regardless of performance. Then comes debt servicing. Following years of restructuring and expansion, Caesars carries significant long-term debt. Interest expenses remain constant. In a higher rate environment after 2022, refinancing becomes more expensive. That pressure does not sit at the corporate level alone. It flows down to asset-level performance requirements. Now add capital expenditure constraints. A full-scale renovation of a property like the Flamingo Las Vegas would require hundreds of millions of dollars. But capital allocation is selective. Priority goes to assets with higher return potential. That leaves legacy properties in a phased upgrade cycle. Depreciation continues. The asset ages, but reinvestment does not fully offset that decline. This creates operating leverage pressure. Small drops in revenue have amplified impact on profitability. And the signals are already visible. Rising fees, inconsistent service, delayed maintenance. These are not isolated issues. They are indicators of a system already under constraint, not one preparing for it. The pressure on the Flamingo does not exist in isolation. It is part of a broader shift across Las Vegas. Data from the Las Vegas Convention and Visitors Authority shows that visitor growth is no longer consistent. Some months show flat or declining volumes compared to prior years. At the same time, traffic through Harry Reid International Airport has shown periods of stagnation, signaling softer inbound demand. But the more important shift is structural. The Las Vegas Strip is increasingly driven by high-spending visitors. Premium resorts are capturing a larger share of total revenue. Meanwhile, local casinos operate under a different model, focused on repeat customers and lower volatility. Properties in the middle face compression. At the same time, online gambling and mobile betting continue to expand. They do not replace Las Vegas, but they compete for discretionary spending. Every dollar spent digitally is a dollar not spent on the Strip. Now combine that with macroeconomic pressure. higher interest rates, increased travel costs, more price-sensitive consumers. The result is a market that is still active, but more selective. And in that environment, consistency and value become critical. Because demand is no longer guaranteed. It has to be earned. The Flamingo is still busy. Rooms are filled. Foot traffic remains strong because of its central position on the Strip. And yet, the experience is weakening. That is the paradox. Demand exists, but satisfaction is declining. Pricing continues to rise through layered fees, but perceived value is falling. The property still generates revenue, but the underlying asset continues to age. On the surface, the system appears stable. Underneath, the alignment is breaking. Because in a sustainable model, price, experience, and expectation move together. Here, they are diverging. Guests arrive because of location. They leave questioning the value. And that gap matters. Because once perception shifts, it compounds. Reviews spread. Expectations adjust. Repeat demand weakens. The property does not fail immediately, but it becomes more dependent on first-time visitors and less supported by returning ones. And over time, that dependency becomes a structural risk. The Flamingo is still operating, still generating revenue, still positioned at the center of one of the most valuable corridors in global tourism. But that is no longer the question. The question is whether this structure can hold under changing conditions. Because the pressures are already visible, fixed obligations continue to rise. Capital deployment remains selective. Guest expectations are increasing. Competition is improving. And the current model relies on a narrow balance. Location compensates for product. Demand offsets inconsistency. Pricing fills the gap created by rising costs. But what happens if that balance shifts? If demand softens even slightly, if guests begin prioritizing value more aggressively, if competitors continue upgrading while this property moves incrementally, then the margin disappears. Not suddenly, gradually. And that is the real test. Not whether the Flamingo can operate today, but whether it can remain relevant in a system that is evolving faster than it is. Because Las Vegas does not stand still. And any property that relies too heavily on what it used to be eventually faces a different kind of pressure. Not collapse, but irrelevance. If you want deeper breakdowns like this, subscribe, follow, and turn on notifications. And if you want to understand how other Vegas properties are navigating similar pressure, watch the next analysis.